So it's 2026, and it feels like the US economy is telling two completely different stories, right? You've got the official story, the one you hear in the headlines, and then there's the story you feel every time you go to the store or check your bank account. In this explainer, we're going to break down that disconnect.
And this is really the core question, isn't it? The news keeps saying inflation is cooling, but your wallet is telling you a very different story. I mean, whether you're buying a car, booking a flight, or just grabbing groceries for the week, it sure doesn't feel like things are getting cheaper. We're going to unpack exactly why that feeling isn't just in your head, it's a critical part of the real economic story.
And this quote just absolutely nails it. It's this shared, almost universal experience now. That little moment of hesitation, that small gasp when you see the total at the checkout. This sticker shock is way more than just a feeling. It's a powerful economic force that's shaping how people spend, save, and maybe even how they vote.
To really get what's going on, we need a key term, vibration. It's the perfect word to describe this bizarre situation where, on paper, the economic data looks pretty solid, but the general vibe, the public mood, is just one of deep anxiety and stress. This isn't about ignoring the data. It's about figuring out why that data isn't capturing the full human experience of the economy right now.
All right, first up, the great disconnect. Let's dig into the numbers behind the official story and stack them up against how people are actually feeling out there.
Okay, so let's start with the official narrative. This chart shows the headline inflation rate, and according to the government, it was down to 2.7% at the end of 2025. Now that is a massive drop from that staggering 9.1% peak we saw a few years back. On paper, this looks like incredible progress, right? We're getting so much closer to the Federal Reserve's 2% target. So mission accomplished? Well, not so fast.
Because this slide shows the other side of the coin perfectly. The Consumer Sentiment Index, it's down to just 54. That's a 25% drop in confidence in just 1 year. And get this, people expect inflation to be around 4.2% over the next year, which is way higher than the official rate. So here's the bottom line. Even as the rate of price increases slows down, people are still bracing for more pain.
You know, this whole disconnect, it really begs a bigger question. Are we even measuring this stuff the right way? In our next section, let's pull back the curtain and see how the sausage gets made. We'll compare the government's method to a newer, real-time approach.
So think of it like this. On one side, you've got the official scorekeeper, FRED, which is the Federal Reserve's data system. It uses monthly numbers from the Bureau of Labor Statistics. On the other side, you've got a real-time tracker called Trueflation, which uses millions of data points every single day to get a faster read on the economy.
And wow, the difference is pretty stark. While the official data for December 2025 showed 2.7% inflation, Trueflation's real-time index from mid-January 2026 had already dropped to 2.11%. What this tells us is that the official numbers are playing catch-up to what's really happening in the market. That feeling of high prices sticks around even when the real-time trend is already cooling off. So what gives? Why the gap? Well, the official data is based on monthly surveys, and it can have a lag of up to 45 days. Trueflation, on the other hand, is scraping over 30 million data points every single day. But here's what's really wild. As the Fed has been raising interest rates, the correlation between these two measures has tightened to an incredible 0.99. This basically means the real-time data is a super powerful sneak peek of where the official numbers are headed next. Okay, enough with the abstract data. Let's get real. Let's look inside your actual shopping cart, because we need to talk about why certain items are getting so painfully expensive, all thanks to some major forces squeezing the commodity markets. All right, let's start with a big one, beef. Prices for beef and veal shot up nearly 15% in just 1 year. This isn't just some small bump. This is one of the biggest drivers of what we call kitchen table inflation. The price hikes you feel most directly when you're just trying to feed your family. So why is beef so ridiculously expensive? Well, it's because of this fascinating, kind of counterintuitive thing called the beef supercycle. It works like this. When prices get high, ranchers want to expand their herds. But to do that, they have to keep their female calves for breeding instead of sending them to market. And what that does is it actually makes the beef shortage worse in the short term, squeezing the supply and pushing prices even higher. The USDA is projecting record-high cattle prices through 2026, with real relief not expected until herd rebuilding really kicks in around 2027. Okay, so let's zoom out from the farm to the whole globe, because this is about way more than just beef. Check this out. The production of key commodities, everything from cobalt to coal, is becoming dangerously concentrated in just a handful of countries. And that means our global supply chains are super vulnerable to geopolitics, trade wars, and frankly, the ambitions of global powers. And this is fueling what some are calling the metals power race. Just look at these forecasts. Gold is predicted to surge past $5,000 an ounce. And get this, it's not because of traditional economics. It's because central banks around the world are buying it up to diversify away from the US dollar. Copper prices are soaring because every new AI data center and every power grid upgrade needs tons of it. But then you have lithium, which is actually expected to fall 25% because of a flood of new supply from Chinese-backed mines in Africa. Each metal is telling its own story about power, technology, and global competition. So all these persistently high prices, they've triggered a massive shift in how we all shop. Next, we'll look at how you, the shopper, are pretty much rewriting the rules for the world's biggest companies.
So here's the big takeaway. For the last few years, big companies could pretty much just pass on their rising costs directly to you. Well, that window has slammed shut. Consumers have hit their limit, and now they're actively pushing back, forcing these companies to find totally new ways to compete.
And this has led to the rise of what experts are calling the value seeker.
Almost half of all consumers now fit this profile. And get this, that includes over a third of high-income households. This isn't about being cheap, it's about being smart. People are actively giving up some convenience, making more cost-conscious choices, and hunting for deals. This is a fundamental shift, and it's forcing brands to compete on delivering real value, not just slapping a higher price tag on the same old product.
Okay, so we've seen the data disconnect. We've felt the shopping cart squeeze, and we've talked about the shift in consumer power. Now let's put it all together and see what the experts are forecasting for the rest of 2026.
Here's a quick snapshot from some of the biggest names in the game, and the consensus seems to be that inflation will likely remain stubbornly above the Fed's 2% target. Morgan Stanley sees it around 2.6%, while the more pessimistic Congressional Budget Office puts it at 3.1%. And while they all have slightly different worries, from tariffs to a K-shaped economy, their conclusion is basically the same. Expect moderate growth with inflation that stays sticky and persistent.
Now, this brings us to something that is super important to clear up, a huge misconception a lot of people have. Many people say they just want prices to go back to 2019 levels. But for that to happen, we need deflation, where prices are actually falling across the board. I know that sounds amazing, right? But in reality, it's an economic nightmare. It leads to companies losing money, which leads to widespread layoffs and even depressions. The real goal is disinflation, where prices are still rising, but at a slower, much more manageable pace. So unfortunately, the high price levels we have now are pretty much baked in.
And all of this really leaves us with a final, pretty provocative question. We're stepping into a new economic reality, a new normal where the cost of living has been permanently reset. So as this new landscape settles, we really have to ask ourselves, what does affordable even mean anymore? And how do we build a future where a good life is actually within reach for everyone? It's a puzzle we'll all be working to solve long after 2026.